If you missed Palantir or you missed Nvidia, the natural temptation is to start hunting for the next miracle. That is what most people do. They go searching for the next stock that can go up 500%, 1,000%, or more. They search for the next chart that can make them feel as though they have escaped the ordinary arithmetic of life. I understand the temptation. There is something intoxicating about the idea that one theme, one stock, one breakthrough, one act of courage at the right time might change your whole financial life. And every now and then, that does happen. But the truth is harsher than most people want to hear. Finding the right theme is only half the battle. Sometimes it is not even half, because a great technology story can still become a terrible personal investing outcome if you do not know what to do after the stock goes up. That is the real lesson in this document. Not that quantum computing is exciting. It is not that some of these stocks moved like rockets. They did. The deeper lesson is that a person can be completely right about the future, completely right about the theme, even early, and still end up with disappointment if he does not understand what to do when a real winner becomes a mania, then a drawdown, then a test of character. That is the difference between seeing opportunity and converting opportunity into lasting wealth. Most people never learn it. They think being right is enough. It is not. Being right is the beginning. What you do with being right is the part that decides whether you become richer or simply more emotional. That is why I want to begin with a hard truth. The market pays people for two separate skills, not one. The first skill is recognizing something important before the crowd fully understands it. The second skill is surviving your own success without turning it into failure. That second skill is rarer than the first. Much rarer, people love to talk about how to find the next Nvidia. Almost nobody wants to talk about how to manage a stock that has already gone up 300%, 600%, 1,000%, and is now trying to teach you whether you are disciplined or merely lucky. That is the part where life-changing money often appears on the screen and then disappears again, not because the theme was fake, not because the company was worthless, but because the investor never had a real framework for what came after being right. That is what happened here. And it is worth studying because the underlying theme is still one of the most important themes of the next decade. Quantum computing is not a toy topic. It is not a sideshow. It is not just another temporary market obsession invented to fill time between AI headlines. It is potentially one of the most consequential technological transitions of this century. That is not a small statement. And it is why I think this document deserves to be read in two layers. The outer layer is the obvious one. Quantum computing may still become a giant investment theme. The inner layer is the one most people desperately need. Even a giant theme can still make ordinary investors miserable if they do not understand timing, valuation, position sizing, and exit discipline. Both layers matter. Now let us talk about quantum computing itself. Because if you are going to invest in a theme like this, you have to understand why it is worth anyone's attention in the first place. The simple version is that ordinary computers process information in bits. A bit is either 1 or 0, yes or no, on or off. A classical computer is fantastically powerful, but it still works through that architecture. Quantum computing is different because it uses qubits, and qubits allow states that are not simply 1 or 0 in the classical sense. That is why people say a quantum computer can explore many possibilities at once. The phrase is repeated so often that it sounds like marketing. It is not merely marketing. It points to the basic reason this technology matters. For certain classes of problems, classical scaling eventually runs into walls so large that even extraordinary improvements are not enough. Quantum approaches promise something different. Not a small gain, a different form of computation. That is why the comparison in the source document matters so much. A regular computer reads one page at a time. A quantum machine, in the popular metaphor, reads every page at once. Metaphors simplify, but the point remains powerful. This is not just a faster horse. It is a different machine. And once technology becomes a different machine, entire sectors can reorganize around it. That is the real source of long-term investment opportunity. Not hype, not headlines. Reorganization. The source document builds the case around Google's proof point, around government spending, and around the acceleration of the whole field. That is the right structure. The key judgment is that quantum computing is no longer merely a distant laboratory curiosity. It is becoming a strategic technology in which governments, militaries, scientists, and major corporations all have reasons to keep spending, regardless of short-term market fashion. That is what I care about in a large theme. I am not looking for excitement. I am looking for inevitability plus early misunderstanding. The best themes usually have that shape. The crowd still thinks it is optional or speculative. Meanwhile, the serious money already treats it like infrastructure. That is what happened with semiconductors. That is what happened with the internet. That is what happened with cloud. And now, in a more early and volatile form, that may be what is happening with quantum. The source document throws a lot of numbers at you because numbers help people feel the scale, and the scale matters. Government commitments measured in the tens of billions, Department of Energy support, Department of Defense support, national science funding, international competition. An expected market opportunity reaching into the hundreds of billions by 2040. Whether every estimate lands precisely where the document says it will is almost secondary to the deeper truth. This field is no longer waiting for permission to be taken seriously. It already has it. That is why I think the analogy to the military origins of earlier technologies is useful. When states begin treating a technology as something they cannot afford to lose, they fund it differently, they think about it differently, they plan around it differently. Quantum is increasingly in that category, not because it will replace every classical computer on your desk. That is not the point. The point is that for encryption, optimization, defense, infrastructure, advanced computing, and certain types of material and systems problems, the stakes are large enough that no major power wants to be late. And when no major power wants to be late, money keeps flowing. That matters for investors. The source document also emphasizes that the timeline is moving faster than many expected. Again, maybe not smoothly, maybe not in a straight line, but faster. It mentions research advances in quantum error correction, more efficient algorithms, and the terrifying possibility that progress in this field eventually threatens existing encryption systems. That is not a side issue. If quantum computing pulls forward the timeline on breaking or undermining current cybersecurity assumptions, then it stops being a cool science story and becomes a national urgency story. That is where I think many retail investors still underestimate the theme. They hear quantum and imagine one more futuristic buzzword. Governments do not fund buzzwords like that. They fund strategic asymmetry. And quantum, if it works, is strategic asymmetry. You will need it to protect military networks, financial systems, critical infrastructure, communications, and eventually a great many civilian systems too. This is why I take the overall theme seriously, and it is why the first half of the source document is substantially right. The big opportunity did not vanish just because some stocks crashed. That is a crucial distinction. A stock can crash and the theme can remain correct. In fact, many of the biggest long-term themes in history were nearly impossible to ride well precisely because the early path was so violent. Investors forget that now because hindsight makes everything look smooth. It was not smooth. The internet bubble still produced the internet age. Semiconductor booms and busts still produced the semiconductor age. Every truly transformative theme seems to go through the same emotional cycle. First, disbelief, then excitement, then mania, then disappointment, then slow rebuilding, then real dominance. Most people only remember the final stage. They do not survive the earlier ones. That is why I think the source makes a useful point when it says every great innovation tends to go through a surge, then a brutal reset, then a much larger eventual opportunity. If the technology truly matures, that pattern matters because it reframes the collapse. A severe drawdown does not automatically mean the story was fake. Sometimes it means the market got ahead of reality, overshot, and is now forcing everyone to relearn the difference between a great theme and a well-managed position. That is the real work. And it takes us to the most painful part of the story. The picks were right, the gains were real, and still many people lost most of the emotional value, and in some cases much of the financial value because they did not know what to do after the move. That is a profoundly human problem. It is not just about charts. It is not just about greed, though greed plays a role. More often it is about confusion. A stock goes up 1,000%. The investor feels genius and terror at the same time. He knows he should probably do something. But what, sell it all and risk missing another doubling? Trim it and feel foolish if it keeps running. Hold it and feel smart until the turn comes. This is where process matters so much more than intelligence. The reason most people fail with huge winners is not that they are stupid. It is that they had no policy. And in the absence of policy, emotion becomes the manager. Emotion is not built for this. Emotion is built to cling when things are rising and panic when things are falling. In other words, emotion is structurally designed to make you late on both sides. That is why real investing requires rules. Not because rules are glamorous, because the best time to decide what you will do with a stock is before it tests your nerves, not while it is actively doing so. The source document hammers this point because the writer clearly sees the same tragedy over and over. People can find a 10-bagger and still end up miserable because they never knew where, why, or how they would sell. That is one of the most important truths in speculation and growth investing. Picking the winner is only one half of the problem. Managing the winner is often the larger one. Now let us turn to the three companies, because this is where the document becomes more concrete, and, if you read carefully, more nuanced than the usual hype. The first is IonQ. This is the revenue leader in the group that matters, because in emerging technology sectors, revenue is often the first dividing line between science project and business. A sector can remain full of promise for years while still producing almost no real commercial evidence. So when one company starts producing unusually large revenue relative to peers, that matters. The source document frames IonQ as the first publicly traded pure play quantum name to cross roughly $100 million in annual revenue with accelerating growth and a very large cash pile. Those are not small details. Revenue tells you something is being sold. Cash tells you management has time. Time matters enormously in deep tech industries, because the companies that survive the valley between technical promise and commercial scale are usually the ones with enough money to keep funding the bridge. That is one reason I respect IonQ's position. Not because it is necessarily cheap, the source itself says it is not because it is risk-free. Nothing in this space is, but because revenue plus cash plus strategic ambition is a very different setup from hope alone. And IonQ's strategic ambition matters here too. The document highlights the Skywater acquisition angle and the move toward becoming a more vertically integrated player. Vertical integration is one of those things investors repeat without thinking. Let me simplify it. If you own more of the chain, you own more of the dependency, you own more of the speed, you own more of the manufacturing path, and in a world where government contracts and strategic technology matter, those things are valuable. The DMEA, related approval. The source mentions may sound bureaucratic, but bureaucracy is often the gatekeeper of real defense and national security opportunity. That is not sexy. It is still important. So IonQ looks like the grown-up in the room, not a mature cash machine, but the revenue leader, the balance sheet leader, and the one most obviously trying to become a real integrated business, rather than just a fascinating science experiment. That is a strong place to begin. The second name is D-Wave. This is where the story becomes more interesting, because D-Wave is different in method and therefore different in investment character. The document explains that D-Wave uses quantum annealing rather than the more general gate model approach pursued by many others. Most people will stop paying attention there because the technical distinction feels too deep. But for investors, the more important interpretation is simpler. D-Wave is pursuing a narrower form of usefulness that can address optimization problems. Now, routing, scheduling, supply chains, logistics, those kinds of things, in other words, D-Wave. S appeal is that it may be commercially usable earlier in specific domains, even if it is not trying to win the same kind of race as everyone else. I find that attractive, not because narrowness is always better, because immediate use cases are precious in frontier fields. A technology that works today in actual business problems has a different profile from a technology that may someday become extraordinary, but is still further from recurring commercial fit. The document notes D-Wave as customer list growth and unusually attractive margins for something doing hard hardware plus software. Margins matter because they tell you something about pricing power, differentiation, or both. Again, the revenue is still small. This is not some fully scaled business, but the shape is interesting, and interesting shapes in early stage sectors can matter more than raw size. I also took the same thing from the investor day comment that the source did, though I would say it more cautiously. When a company plans to go stand in front of investors and celebrate the direction of the business, it is usually a sign that management believes the story is improving rather than breaking. That is not proof, it is a clue. And in risky sectors, clues matter. Then we arrive at Rigetti, which the source clearly loves most on a risk-reward basis. This is the most dangerous and perhaps the most seductive of the three stories. That is usually how it goes. The least mature financial story often sits next to the most exciting technology story. Rigetti's revenue picture is weak relative to the others. The source is candid about that, and I respect it for being candid. This is not a revenue machine story. It is a technology story, and that means the investor is being asked to underwrite technical progress ahead of financial proof. That is always risky. But high upside usually lives where the proof is incomplete. That is the bargain. According to the source document, Rigetti's appeal rests on its technical progress, fidelity achievements, fabrication control, NVIDIA-related integration, international contracts, and manufacturing partnerships. That is a lot of good narrative material. But it is still narrative material attached to a company with very modest revenue and much less operating proof than the revenue leader. That is exactly why the stock can offer enormous upside and still be the one you should handle with the most caution. This is one of the oldest truths in growth investing. The best story often belongs in the smallest size, not because you dislike the company, because you respect uncertainty. I think that is the mature way to think about Rigetti. Not as a sure thing, not as the obvious winner, as the kind of name where if the technology catches up to the dream, the revaluation could be astonishing. But until that happens, you are being paid in excitement, not in established proof. That is why the chart matters so much in the source writer's framework. And here I want to say something that is easy to miss. You do not have to worship charts to understand what he is really arguing. He is arguing for timing discipline. He is saying that after these stocks went vertical and then crashed, the wise approach is no longer to chase emotional highs, but to wait for stabilization, confirmation, and higher probability entries. That is not technical mysticism. That is just patience. And patience matters even more in themes like this because the volatility is not a bug. It is part of the system. Now, if I step back from the three names, here is how I would frame them in plain English. IonQ looks like the current business leader. D-Wave looks like the practical niche operator with real present tense utility. Rigetti looks like the highest risk, highest upside pure technology bet. If the engineering path keeps improving, that is a useful mental map, not because it predicts the winner with certainty, because it reminds you that even inside a single theme, you are not buying the same thing 3 times. You are buying 3 different types of uncertainty. That distinction matters, and it returns us to the deepest lesson in the whole document. The biggest mistake most investors made was not that they believed in quantum computing. The biggest mistake was that they believed believing in the theme was enough. It was not enough. The source document comes back to this again and again. The picks worked, the gains were real. But most investors still managed to mishandle the outcome because they never had a selling framework. That is not a side lesson, it is the center of the lesson. A theme can be right, the stock can work, and the investor can still lose the emotional and financial war by having no plan once the stock becomes explosive. That is the part I wish more people understood about wealth. Wealth is not built only by being early. It is built by being early enough, disciplined enough, and emotionally steady enough to turn temporary euphoria into retained capital. That is a much harder act than the internet makes it sound. The internet makes it sound as though all you need is conviction. What you need is conviction plus a procedure for what happens when conviction is suddenly rewarded much faster than the business itself can justify in the short run. That is what happened here. The market got ahead of the companies. That does not make the companies bad. It means price outran process. And when price outruns process, risk management becomes the only thing separating a future winner from a future regret. This is why I think the source document is strongest, not when it promises bigger than Palantir or NVIDIA, but when it accidentally reveals something much more useful. The real asymmetry is not just in quantum computing. It is in the investor who learns how to combine a transformative theme with a disciplined framework for taking partial profits, reducing size into manias, and refusing to let one stock become the whole story of his financial life. That is who wins. Not the person who gets excited once, the person who remains rational twice, rational on the way in and rational on the way up. That is why I've always believed that a true speculator must think in layers. The first layer is the theme. Is the world really changing? The second layer is the company, who is actually positioned to benefit. The third layer is the balance sheet, who survives long enough to matter. The fourth layer is price, what is already in the stock. And the fifth layer, which most people skip, is behavior. What will I do if I am right much sooner than I expected? That fifth question is the one almost nobody asks. which is why so many people remain poor despite occasionally having very good ideas. Good ideas are common. Behavioral discipline is rare. And rare skills are usually what build durable wealth. Now, I want to say something important for anyone reading this and feeling late. You are not too late to the theme simply because you were too late to the first frenzy. Those are different things. Being late to the first mania is not the same as being late to the long opportunity. The internet had multiple booms. Semiconductors had multiple cycles. Cloud had multiple waves. AI itself has already had phases. That is what great themes do. They do not move in one straight line. They attract capital too early, then disappoint it, then mature, then justify it, then overshoot again. That is why patient investors can still do very well in giant transitions even after missing the earliest burst, but they only do well if they learn the right lesson from the first wave. The lesson is not, I must buy anything with quantum in the name. The lesson is, I must learn how to separate a valid, long-duration technological shift from the emotional excess that always tries to wrap itself around that shift. That is the real work. And that is why I find this theme so interesting. Not simply because quantum computing could be huge, because it is also the perfect classroom for learning what most investors never learn in time. A real theme does not save you from bad process. It only magnifies the consequences of having one. If your process is good, a great theme can change your life. If your process is bad, a great theme can still leave you angry, confused, and poorer in spirit than when you began. That is what happened to many people here. And that is why I would never tell someone simply to buy the theme and hope. Hope is not a strategy. What I would tell him is this: study the space, study the revenue, study the balance sheet, study the path to commercialization, respect the fact that governments and giant firms are already treating this technology seriously. Respect the fact that the market has already shown a willingness to throw ridiculous money at the space and then tear half of it back out again. And above all, if you buy one of these names, decide in advance what success looks like, what excess looks like, and what you will do if the stock gives you more money faster than your emotions know how to handle that, is the whole game. Because if you miss Palantir or Nvidia, the point is not to become desperate. The point is to become better. Better at identifying the next great theme, better at distinguishing the stronger business from the weaker story, better at surviving volatility, better at harvesting success before success turns into another lesson about what you should have done. Quantum computing may well become one of the great technology stories of the next decade. I believe that is possible, but the people who truly profit from it will not only be the ones who are early, they will be the ones who understood that in the market being right is expensive. If you do not also know how to keep what being right gave you, that is the final lesson. Not fear, not hype, not cynicism, competence, theme competence, business competence, and hardest of all, competence with your own emotions when the numbers become large enough to change the way you feel. That is what separates a good idea from a finished outcome. And if you can learn that here, then whether your next great winner is quantum or something else, you will finally have the part most people never build. Not just a nose for opportunity, a system for surviving it.